The opium era of easy money has ended. The Federal Open Market Committee maintained its benchmark interest rate at 3.50% to 3.75%. But newly appointed Chairman Kevin Warsh utilized his debut meeting to orchestrate a profound, hawkish regime shift focused squarely on price stability. For nearly 5 decades, global financial markets have been hopelessly hooked on the intoxicating elixir of low interest rates and reliable central bank rescues. Whenever the economy stumbled, the Federal Reserve rushed to cut rates, flooding the financial system with cheap capital. This continuous support institutionalized a dangerous moral hazard and decoupled stock market highs from underlying economic reality. Today's historic FOMC meeting marks the definitive end of that long, soft money epoch. The central bank completely scrubbed its policy statement of any language indicating a cutting bias. Instead, the Fed introduced a starkly leaner, simplified memo focused exclusively on absolute inflation control. This structural overhaul confirms that the generous policy cushion market participants have long taken for granted is gone. Enter the Volcker mindset, the era of Kevin Warsh. Chairman Kevin Warsh is entirely willing to step into the aggressive, anti-inflationary footwear of legendary Fed Chair Paul Volcker. In his initial press conference, Warsh was unyielding, declaring that this committee will deliver price stability. He insisted that the recent history of volatile prices need not be prologue. Warsh backed this strong rhetoric with tangible, institutional disruption. He refused to participate in the traditional forward guidance dot plot forecasts, publicly questioning their efficacy. Furthermore, he announced 5 sweeping operational task forces to evaluate the Fed's communication and balance sheet mechanics. The message to global markets is unmistakable. The modern central bank will no longer handhold investors. It is transitioning into an unyielding inflation-fighting regime where financial markets are expected to stand on their own feet. Why this regime change changes everything. The true scale of this monetary pivot is laid bare in the Fed's updated economic projections. Rate cut expectations erased. Earlier market assumptions of multi-rate cuts for 2026 have vanished. Half of the FOMC members are now openly forecasting a looming rate increase by year's end. Inflation projections raised, driven by sticky domestic indicators and supply chain pressures from the Middle East conflict. The Fed sharply elevated its 2026 inflation forecast to 3.6%. The new reality for markets. Deprived of its reliable monetary medicine, Wall Street reacted with immediate anxiety. Major indexes went down as yields on shorter-term treasuries surged, the bottom line for investors. This is not a minor policy tweak. It is a profound structural transformation. Market signals will be defined by stricter liquidity and a Fed that values economic stability over equity portfolios. The opium era is over, and the market must rapidly sober up to survive. Is the market ready to survive without the Fed's safety net, or are we heading toward a major valuation collapse? Drop your thoughts in the comments below. Share this post with an investor who needs a reality check. Turn on notifications for market signals to get our upcoming deep dive on how to reallocate your portfolio.